Up
right,
and running.
we are live. Okay. All right. I just want to welcome everybody to the launch of our channel 876. Want to just welcome everybody to the launch of the 876 Invest YouTube channel right here, and we are here to present to you what's going on with GameStop. So, everyone, without further ado, could you just like, comment, subscribe, share with everyone else, and we can get on with the show, right? So once again, I'm Justin Scott, of 876 Invest, and joined here by my co-hosts.
Schaunn-Anthony Thomas. You know me from the last video we did, I think, or the one before.
Right.
David Nunes. Y'all know me from the video with me and Justin for UA.
And Nicholas Dundas, I think Sean and I did the Signals APO breakdown.
Right. So let's really just get into the hottest thing going on in all the financial markets right now. The situation, the event that everybody has their eyes on: Gamestop, AMC, and WallStreetBets. Right. So we're just going to get into a little more topics so you guys can understand the situation, what's going on, learn from it, and see and pretty much just get an insight into the discussion that we're having right now and see where this is going for you all. Right. Okay.
So I think we're gonna start off with Dundas just letting us understand a few things about some terms like shorting and what's exactly is happening.
Right. Yeah. So basically, we're going to go through what's going on entirely, and effectively, what's going on, what's causing all the hype around GameStop, is the fact that they are being short squeezed. And so I'll start from the basics, which is what a short is. So in essence, when you're a short seller or if you're short in a company or a commodity, whatever it is, what happens is in the instance for stocks, basically you borrow the shares from, for example, the broker, or you borrow the shares from someone with the intention to return those shares to the seller at a lower price. So basically, you'll be making a bet on the share price falling. So you borrow the shares, and let's say at $10 from the owner, and you expect it to fall to say like $8. And when you buy it back at $8, you'll be able to pocket the difference. That's how money is made from shorting. So what happens in essence is companies have the short positions, and the way you lose money obviously is the flip side. If the price goes up, then your short positions would be at a loss. So what happens is if the price continues to go up caused by buying pressure, then people who have short positions may start to fret and try to recoup their losses or close their positions. In order to do that, they have to purchase the shares to return to the seller. So in order to return the shares, when they buy back shares, that's more buying pressure. So when the buying pressure increases, more persons in short positions begin to feel the same pain you felt before, and the buyer pressure increases and increases. So then there's just a roll-on effect of constantly buying and buying and buying, which continues to the price higher. And that's exactly what's happening with games, where we saw, was it like a couple thousand% growth, or 500% growth in the last couple of days?
1,700% in total.
1,700% in total. All right, so.
And is that 1,700 year to date?
Is it?
I believe it's year to date, yeah.
Late December, early January. That's the part I don't know.
December,
But I know the entire run, 1,700%.
That's correct.
Year to date is about 1,200%.
Yeah.
It's in madness.
Right, and I mean we'll get deeper into what caused this short squeeze, but it's basically just excess demand for those shares, and get going up and up.
Yeah. So basically,
All right, so I noticed there, Dundas, that you said it was short squeeze from Robinhood, from Reddit, WallStreetBets.
Right, yes.
So is that like something that's legal, Justin? Can they just get up and do that? Or even ethical even?
All right. Well, as it relates to the concept of ethics, in this situation, it's the simple use of market mechanics, right? That's, to me, that's how it comes across to me. It's a matter of a market is simply a place where buyers and sellers meet, and so that's what took place. And if you buy something before you actually, say if you were to buy a sharing company and you haven't gotten across to actually paying for it yet, or if you're selling something and you actually haven't received the thing that you're selling as yet, then on both sides of the thing you have a debt to be paid. So what happened was Melvin Capital, they were shorting GameStop, and essentially they were borrowing the shares, sell off to people, and in the intention to buy it back at a lower price, as Dundas was explaining, so they could pocket the difference, right? And what happened is the Reddit users on WallStreetBets took notice of just how deep the short interest was, over 100%. They realized that, hey, because it's all public information. Oh, that's what saying something. Yeah,
I think it was like 138% short interest at one point.
Right, so over 100% of that. And they took notice of this and decided and they recognized that should they buy up the shares and hold it based on the laws of supply and demand, then naturally when it comes time for Melvin to sell back the shares that they bought, they'd have to be buying back at a higher price and selling back at an extreme loss, leading to around over 50% drop off in Melvin Capital's equities year to date. Right?
And we're 1 month in, wild.
1 month into the year. And it's not a matter of it's not a matter of unethical or illegal, because it's simply the Reddit users on WallStreetBets taking notice of the situation, and then they're doing what's best in their own best interest. It's just a matter of noticing their advantage as players within the market. Right?
Okay.
Because it's not like they're going to continue buying the stock. Like they went up to about $300. Right?
Huh?
It's not as if they're going to
$500, bro.
Over $500. So what I'm saying is they didn't just buy it to keep it there for the whole time. They wanted to benefit off the cap gains as well. So it's simply just them as market participators recognizing advantage, recognizing a benefit that would come across with the increasing value of the company at a later date, and taking advantage of it by buying the shares. It didn't necessarily have to be a matter of malevolent behavior to inflict damage upon a particular company, right? Or just participants do what they do.
Makes sense. One thing I want to touch on before we go forward is the over 100% shorting. As Dundas explained, shorting is when you borrow shares in the hope that you borrow shares and sell them in the hope that the price goes down and you can buy them back at a lower price. What happens is, how it comes to be that you can short more than 100% of the company is Justin can borrow shares from Dundas, and then I can borrow Justin's borrowed shares from Justin and have the same kind, and it can go on like that. So over time, what ends up in the share quantity amount that ends up being shorted is greater than the share amount outstanding. So that's how the over 100% short comes in, for the people who might be confused there.
And that can be done straight through the equities to the share price, the shares itself, or it can also be done through options. So you can people buy puts with the same intention to benefit from the downside of the stock. You buy puts or you sell calls. Put options.
Exactly. I think Nunes was going to tell us about how much of these retail traders have come in the market and how it's been affecting the markets generally.
Okay, so we can see that from 2020, the rise of retail traders has been enormous. And part of that reason is attributed to the fact that we're all here at home. A lot of us who either have received, and I'm talking about for our foreign counterparts here, who have received stimulus checks and who has had some savings saved up and, have just become very interested in what the stock market had to offer overseas and say, you know what, I'm home. And for the ones that lost their jobs, I've lost my job and I have nothing else to lose. And my stimulus check has just come in. So what is my next move? And Robinhood in particular as a brokerage house has become so popular Um, did I chip out a while ago?
Yeah.
you did.
Okay. And back to what I was saying, there's become plenty of different types of bets on different stocks, different blogs, in particular Reddit and Wall Street Bets, where we can see people on a daily basis. It's not just GameStop or AMC discussing plenty different stocks. However, it seems as if these traders had struck gold with the GameStop trade by looking on the short the shares that were shorted, and as Sean said earlier on, over 100% of the shares were shorted, and explain how that has become possible. So with that and this anticipated earnings results, companies that were still performing really well even during the pandemic, and how well the S&P 500 was doing, and of course that March crash, everybody was okay, let's buy on the dip, and there was real hype around the stock market. So these Robinhood traders absolutely flooded the markets, helped
Right.
almost, and I wouldn't say single-handedly, because that's where we get to talk about the short squeeze that Dundas spoke about, where we know that once these companies see that they're in positions that are losing, they have to start buying up. So it's not only the Robinhood traders, they were mere instigators, in my opinion.
Mhm.
So this flood of trading, we've never seen it before, because the last pandemic we weren't privy to so much platforms that we're privy to now. I mean, the 2008 financial crisis is completely different than this one. And so right now in this COVID crisis, where people actually can't move out of their confinements for the most part, we find an increase in risky investor behaviors, as some of these CEOs have said, and probably we as young people just regard it as high edge investing. But I mean, it has paid off for some people, and at the same time, it has burned for some people, which we will get into more as we
As
continue
we go
speaking
along.
about this topic.
Right. Because one of the things that even were one of the things would have alerted the people on Wall Street Bets are the developments and timing of things, right? So what happened is the Ryan Cohen in late 2020 was the CEO of Chewy. Chewy is an online retail business. Became bought out a 9 million share investment into GameStop at the time in late 2020. Right around that time, the PS5 and the new Xbox models would have been released. And even though gaming isn't the same that it was, say, 10 years ago, when GameStop was one of the leading retailers, right, providing games, consoles, and other accessories. We're now in a case where people can buy all these things online, have it delivered to them. So they're an old model of just simply being a retail giant within strip malls or wherever the other locations were. It's been more of a case where people can just buy them where they feel like. So the old model that GameStop was working with just wasn't working as much, and you can understand why the prices might go down because of that. But at that point in time, it was enough to drive certain sentiment, to drive interest in the stock. But because of just how badly it was shorted, it is one of the things that stood out to some of the users on Reddit, found the value there, and just just outlined the situation.
Yes, that's true, because I mean, when you look on how the gaming market has changed, and it's been changing for the past 5 years,
Indeed.
because
Indeed.
I mean, amongst all of us here, how many of us actually own a lot of CDs? Because on our Xbox, on our PS, we rather buy them, as we would
Digital
call it,
version.
in-app purchases. That's
Yeah,
a
break.
similar name like what you do with your OS.
Mhm.
So there's really been a shift from the brick and mortar going in store to buy video games, as when we were probably 10 years old. Remember going to what's new and
What's
trying to
new?
purchase
Yeah, yeah.
a game and
Yeah.
so on. But now we have the
Definitely.
luxury of saying we have a PSN account, or an Xbox Live account, and we
Mhm.
can purchase these games online. So especially with the pandemic, that hasn't helped, because a lot of the retail stores have closed down. So GameStop, and I wouldn't even like to talk about AMC. which is
In
a
that regard,
movie
right.
company, you know, and there's no going to movie theaters because that gathering is very intimate. So it's a similar sentiment that has happened to these two giants, you know, retail giants, because they've basically lost their business even greater as at an accelerated pace throughout the pandemic. Because if you did looking at forward earnings for these companies, probably 3 4 years ago, you would see a switch happening and be like, okay, these companies are now entering a territory where it's going to become difficult for them. And then this pandemic absolutely accelerated all these losses. And you can see why. I mean, to think
Indeed.
logical, you would short a company like these, you know,
Right.
in a logical sense.
Right.
I know this, but they lost a
But
lot
you
of
know what's
steam
been.
with COVID. Well, I want to finish, Sean.
Go ahead,
I was
Dennis.
saying that they lost a lot of steam. I mean, even pre-COVID, with just the transition from CDs to the more digital age. I was listening to Jim Cramer this morning, as a matter of fact. He was talking about how GameStop, even though the model is basically a dying model, but another thing that might have piqued the Wall Street bet people's interest is the fact that even though it's a dying model, GameStop would have had probably one decent quarter, which is the quarter ended December, the one that was supposed to
Exactly.
close for soon.
Exactly.
Why? Because of PS4, PS5 release, and yes, the people don't really buy CDs and other things anymore. But then came that big console that everybody has been trying to get their hands on. So, but then there's a small little bit in interest that probably would have saved them for a little bit, and I think that's another key variable in why they became why they got so savage on this, because how was going on, and it's like there was probably a little bit more violent than people were giving them credit for. He talked about, was the Andrew left from Citron, about his short
Citron,
selling.
yeah.
Citron, sorry,
Yeah.
his short selling report, and this is why these people got savage about this thing. Like, it was not only just the value, because I mean, with this whole as the retail trade, it's interesting to see that this whole meme stock kind of thing, where people, they have other motives apart from just making money from these companies, other these companies. They literally were trying to send a message to Andrew. So it's
Yeah,
kind of
yeah.
interesting to think about.
Yeah,
Yeah, definitely.
that's
I
Yeah.
true.
saw a lot of those
So,
conversations saying that, that this was the great wealth transfer where these retail traders are really trying to show up the hedge fund traders and so. But
Yeah.
the joke is that the second largest shareholder in GameStop is BlackRock. So in Harmon one hedge fund,
Hmm.
they really boosting another one. It's really
Yeah.
interesting that way. Yeah.
I mean, there's that, yeah. But I think the AMC story is really, really cool out of it, because AMC did a whole lot with the situation, right? So AMC wasn't as
Oh yeah.
shorted as GameStop. AMC was about 24 or 25% short interest. I think at peak it was 60. And then
yeah, it was definitely over 50 at one point.
Oh, did my Wi-Fi chip out or?
I believe that's Sean.
Yeah. Okay.
Yeah, so I mean, until Sean
good
come
now.
back, we can. Oh, he's back. Okay, great.
Oh, and prodigal son return.
Yeah, I was saying that in December, I believe, AMC had took on an extra $100 million worth of debt, and they had a material going concern note in their financials saying, I don't know if we're going to make it out of this. They'd gone from, I think, shareholders' equity dipped from over $1 billion to about
All right. Well,
Sean experiencing some problems, man.
there's some technical difficulties. Um.
All right. In the meantime, though, Justin, what was the percentage shot that Sean had expounded on? Because I know it was over 60% at one point.
Yeah.
It
Definitely over
wasn't as
60%
high. It
stuff,
wasn't
man.
half as high as GameStop,
Right.
right?
Definitely. I don't remember the exact figure at the moment, but there was actually a string of of those occurrences that are going on through the WallStreetBets feed. Where they
Sorry about that, guys.
Yeah, don't worry about it, man. So it's the same thing with GameStop, highly shorted. Same thing with AMC. Same thing with NAKD. It's a I guess I would say a luxury retailer. They sell a lot of women's clothing and like swimsuits and everything there, right? So when you realize there was a trend of all of these stocks that were highly shorted at the Wall Street, but people are looking at and just following the same trend over and over. They even up to most recently I heard about silver, where because of the same shorting test they were buying up the silver spot price, right? Buying ETS as well. After that was going
Mining
on, so it's
companies
really
as well.
interesting to see how people are making use of it. Even Dogecoin, that cryptocurrency, that was a thing at the end of last week, January, where after the case was they were capitalizing, taking out the cap gains also, but they could have done on those off of the stocks that brought reinvested it into different asset classes and really just protect the investment.
What I'd wanted to talk about with the AMC though was they took the situation and basically saved themselves from bankruptcy as a result of all of this. So I was saying was their shareholder equity in their balance sheet was over $1 billion in the positive at the end of 2019, and at the end of 2020 it was $2 billion plus in the negative. Now, for those who don't know, AMC is the world's largest cinema chain. So there's been no movies showing through the whole of 2020. So obviously this has had an extremely adverse impact on their financials. They had to take out an extra $100 million worth of debt in December 2020 to try to get some bridge financing, and they even had a material going concern note in their financial statements. However, as a result of the share price running up, a private equity firm that held some convertible bonds, I believe it was, called Silver Lake Group, it was about $600 million worth of convertible bonds. They actually converted the bonds to equity for I think it was 1351, $600 million worth of debt. They converted to equity at 1351, which pretty much that saved AMC. Their CEO released a statement saying, look, the money that we got from that means that we're not going to go bankrupt right now. We'll probably have like another year or two, and once everything opens up, we should be fine once we start generating revenue. So it was very interesting to me to see how.
Yeah, so pretty much what happened was that the bondholders recognized that, well, AMC is pretty much going on at the moment. So rather than just hold on to bonds, but to convert it into equity.
No, not what happened. What happened was they realized AMC is in a bad position and the stock is shooting. So you can make money off the stock. So they convert their convertible shares to stock in order to take some advantage of these cap gains. When they converted it, it was 1351. Since then, the stock fell as low as 6 and came back, and now it's chilling somewhere under 12. So that firm is still in a bad position, but AMC is in a much better position as a result of that firm's decision to convert.
Okay.
That's smart though, because those convertible notes at the time, it would have been known that AMC wouldn't have been able to pay off the interest, probably not even the principal at the time. So converting it to equity was probably in hindsight not the best move, but it's the best that they were available to do, because at least they would have gotten something from that. Worse with the stock price looking like it was in a up or down situation, to be fair, they would end up with something. That was a smart decision.
The share price down from their conversion price, they're still up about 8% in terms of net terms from where they would have been if they just held the bonds. In terms of actual
that's true.
Power that they'd have. So
because those bonds would have defaulted. Indefinitely. As
I said, even the 100 million that they raised was at a rate of 15%. So it was
that's like an unsecured rate.
Yeah, so I just found it really, really interesting how they were able to take that situation and use it to turn from a dying company into a company that now has life and can go on for many more years potentially.
Well, maybe not many more years, but I would say they have survived this leg.
That's a different
Because there
discussion.
can be more setbacks.
That's a different discussion.
They've survived their legs, and they've managed to pay off their obligations for the time being. Because they're not necessarily out of the woods as yet, but they've managed to leverage this run of these Wall Street traders and WallStreetBets traders and these speculative investors. So they've managed to use uncertainty to gain some kind of certain ground in the company for near-term obligations, because it's one to do research, and I would love to know what are their long-term obligations, because they may have some medium to long-term debt that they also need to service. But this current bondholder, the convertible note situation, was an immediate thing. It's nice that they remedy it, but I would love to do some more research on their forward earnings to look what their obligations are in the future, to see if, as you said, Sean, they can survive years. Yeah, I know that. That's what I would love to know.
It's still a whole heap for that. However, I think provided that the space goes as we think it should, and the vaccine rollout will go well and everything,
Yes.
and all of that, and people will actually start to trend back towards theaters, which is a whole separate discussion. But if all of that happens, then AMC should be fine. They have the brand and the staying power.
Well, it's interesting to see. My thoughts on it is that they're not out of the woods as yet, especially with this vaccine rollout. As we can see, it's a two-shot policy currently, right? And it's still up in the air whether or not the first half of the year, if everybody is going to, or 70% of the population is going to get at least their first shot. So, I mean, time will tell. And as we know, these are multi-billion-dollar companies. They burn through cash fast with overheads, debt obligations, and all of that. And also, I mean, the speculation of the stock price going up and down, which allows them to raise more equity and so on. I mean, it may be short term. Maybe we're looking on March where AMC stock is back at like $5, $4, all of that. But it's very speculative at the moment. It's hard to determine because these Wall Street traders may just get up again and say, hey, we're going to run this, but it's really speculative because the company has gotten almost, I would call it a miracle bailout at the moment, a miracle, because as investors, we know these companies weren't looking good at all, and they just benefited from speculative trading. So, I mean,
from gimmicks.
Yeah.
From gimmicks.
It's crazy, yeah, from gimmicks, really. It started from a thread, but that's the power of voice, that's the power of this society now. What we may not have in 2000 when the 2008 financial crisis happened, we have now. We have the power of words. We have many different platforms that we can voice opinions on. Retail traders can now decide that, hey, listen, I am doing this and I'm not doing this with any guidance from any company, because I'll get into that later, how Wall Street actually burned some of these retail traders. Yeah. But in the meantime, back to you, Sean, because I think you wanted to say more.
No, man, I was pretty much done. It was just a very, very interesting point. I think somebody had mentioned Melvin's losses earlier. Justin was 53%.
53, yeah.
53%. That's on their entire portfolio for the month of January.
Just
to keep that clear, 1 month. Their entire billions and billions of dollars portfolio. As well as Citron, who they have Andrew left. He was the main individual target, I guess, if you want to use that kind of terminology.
Yeah.
That they were trying to harm. And they closed out the majority of their positions in GameStop, their short positions in GameStop, losses of 100%, or a little over. So that again is massive losses. Neither of them told exactly how much shares they had shorted or anything like that. But
I know he's then made a statement about he's going to end commentary overall on GameStop, like he's done. He's not going to talk about it anymore.
he's
Yeah.
also said Citron Research is no longer a short selling firm.
Yep.
So that goes to show the power of us retail traders.
I know. Before,
Yeah,
like, on a small tangent, a few months ago, I was just thinking about how different the entire financial scape is now. Like the whole market forces have changed. I was talking, probably one of you guys I was talking to
I
about
think it was me
how,
and you.
yeah, about how basically with the whole, as Nina said, the whole people get stimulus packages now, and everybody sees that stocks are flying and blah blah blah. So everyone wants to invest. What has happened is the rise. When I said that first, it was the rise of the Robinhood trader, and that was just to describe all retail investors. Because I mean, obviously, it's not only on Robinhood, but I saw that there was a time that we couldn't ignore the fact that these. I mean, yes, we're smaller in comparison to hedge funds, but I just couldn't see a way in which I could ignore the scale at which the retail investor was growing, and I could see that there were some small effects on. I mean, obviously nothing to the scale, but everybody was investing in like Tesla and those companies, and Tesla is a company that just doesn't fall, right? And based on like some things you just realize that okay, hedge funds generally would operate more around valuations and fundamentals, while a man like me and you would more likely, well, I talk about myself. I personally factor in sentiment a lot. So, and I mean, I'm sure that this is something that resonates with a lot of retail traders, especially people who aren't experienced and don't have the tools to do valuations. Why? Because it is very easy. I mean, it's bad. It's very easy to look and say, yo, okay, Tesla is doing well. Everybody buys Tesla, so I'm going to buy it too. And what happens is, regardless of what people want to say about the fundamentals don't move stock prices. People do. So I was thinking about how how long would we see? One, is this a permanent change? Will we see retail investors changing the way that the market operates forever, or will this be a pandemic time thing, or what's gonna happen? And to see that they did this like to this scale was so interesting to me because I mean I won't say a side coming because nobody could see this coming, but I just knew
Yeah,
that the
we've been having
retail
a lot of those
traders.
moments last year.
Yeah, man. I just knew the retail traders would just have something to do with like a huge market movement change. And
Yeah,
now I'm seeing exactly how powerful these people really are. It's so interesting.
I agree with you, Dundas, because it's the same. I think I was saying the same thing to you that a lot of institutional money too was still not factoring in how much money retail traders were actually making.
Mm-hmm.
I don't. For those who pay attention to the US stock market, for the past 5 months, it's been an old market is frothy. There's a crash coming, whatever. But
Mm-hmm.
retail traders keep making money and keep making money, and the more money they make, and the more they believe that
There's
where
no
stocks are going to go up,
yeah.
and they invest that money into these new stocks, and more of them do it with larger sums of capital. It's just the richer everybody's going to get and the more power we're going to have as a class of investor,
Mm-hmm.
as our collective net worth all grows.
As the space gets deeper and deeper, and as time goes on, you're going to see a lot more of that. You're going to see a lot more platforms that is popping up. You're going to see a lot more wealthy retail investors investing toward the market, and a lot of these high volatility stocks increasing the market in the way that we would know it as now, as compared to before, when it was a lot less of a sophisticated investor class and mainly more of the institutional traders and so forth, right? But
Mm-hmm.
you see, the reason why that has to happen is because situations like what happened with Robinhood and Webull and some of the other platforms who restricted the traders of buying shares when they just got too high volatility and things are really at a bubbling point, because Robinhood as a broker couldn't afford to meet the requirements of the market at the time, in terms of, I believe, one of the restrictions that the actual
Robinhood is a clearing broker, so
right
they,
is a
they
clear broker.
put the
So I think
order
one of the
through other
restrictions,
brokers. So they
yeah,
need money. They need to have a certain level of capital on hand in order to put the orders through.
exactly. And if and when they actually put these orders through, because they don't clear immediately, they clear in a 2 business day format, or like T+2, right? And so because of that, now one of the restrictions that was placed on them was that they had to put up 100% collateral instead of the usual 10 or so percent collateral that they normally put up through each trade. And because of that, they simply couldn't meet the demand of all the retail traders placing the trades. So they didn't have the cash to put through all of those trades at once, or it was too risky for them. It wouldn't make sense, right? So they restricted it, and because of that, now that's going inside that change going forward. All of these little actions have ripple effects that affect and develop the market each step of the way, right? So you're going to have a lot more firms popping up. You're going to have a lot more clauses to go around these type of restrictions, because I remember at a point Robinhood had actually been selling the shares of the actual shareholders for them at a chosen price, and that's just
That's not okay.
That's not okay.
It's not okay. It's not.
If I'm not selling it and it's my share, then I don't
Yeah.
know you should be selling it for me. That's not okay.
That's not okay. I think you're either going to see that situation or regulations come in. And that's not to say the regulations would be fair, but I just think it's gonna.
But there's definitely development in that sense.
Yeah.
That line going forward.
So it's either you're gonna have a lot of people breaking out and the space is gonna become very retail driven.
Oriented. And decentralized.
Oriented.
Which is all.
Or you're gonna have regulation coming to tie back up the market and be like, all right, let's get it back to what we know it has. Let's get it back to status quo.
You know that thing where they were closing up positions is really insane. I'm not sure if I remember exactly, but I think if memory serves me correctly, it was somebody had a position of over, I think it was like 1,180, something close to that number. GameStop shares at about 250. No, it was like it was over 1,000, and they closed out the position at about 100. That's $100,000 US. Like what? That's just madness. That
Okay, bro.
and you know that they had. I saw in WallStreetBets that they launched a class action lawsuit against Robinhood because of the losses people incurred because of the restriction.
Yeah.
And
I mean, I noticed that. I mean, I've been listening to you guys, and I agree for a majority of what you guys say. I mean, I think all of this that's been happening, the restriction of selling and buying from Robinhood, it's going to bring more scrutiny to these large brokerage houses and the practices of them. Because even earlier on, when you guys spoke about the losses of Melville Capital of over 53%, I mean, it begs the question: who is who is the team behind these hedge funds and brokerage companies? Because that sort of leverage when you're managing people's money, where's the risk to reward ratio? How do you go 53% down off of one trade? Where's your risk? Where's your risk to reward? What's your safety net? I mean, you just blew up so many people's money. I mean, it's kind of crazy when you think about stuff like that, because it goes back to a world where we find, and even as I'm saying, I've soon touched on that topic of markets that are just unregulated, because that kind of leverage in a position, in a short position, whether long or short position, is massive. When it works out, it's all fine and dandy, but I mean, regardless, it's not becoming of traders. It's more like the scenery has become more, even from these big hedge funds which claim that retail investors are gambling on these positions. But so far from what we see from Melville, the same can be said of these large brokerage houses. They're just operating with large sums of cash. And we should recall that it's not only retail investors that are moving the market currently. Actually, it can be argued that the larger volumes are being moved by these so-called hedge funds. So these guys are out there sabotaging themselves and blaming retail traders for the mighty crash. Because remember, for the short squeeze, these highly leveraged funds have to start buying back these shares. I mean, it will be easy for me to believe that retail traders could probably push a stock like GameStop or AMC probably 40% higher. But when we're going into 1,000% higher points now, you begin to think, do retail traders really have this much money? I'm not underestimating their power, but you should realize that a large majority of these shares that are being moved are from the same hedge funds, the same people that are betting against, and the same people that were betting for it to fall because they have to follow the stock now to cover their positions. And I mean, when you think of 53% down from Melville Capital, and this is in the billions, think about the amount of shares that they would have tried to buy back or other companies have tried to buy in order to. And as it is with the stock game, it's very capitalist. You have to capitalize on another person's mistake. And here we go, other companies buying into it. So, I mean, I still have the belief that retail traders were the instigators, but not necessarily the majority of the movers. So I think they're being blamed unfairly at the moment.
I mean, there's definitely
So,
some big money behind it. We saw Chamath Palihapitiya put, what was it? I think 100,000 on some calls, and then Elon
yeah,
Musk made some tweets about it, and we know how it goes when Elon tweets about a stock, it just goes to the moon. So I mean, there was, and of course, short squeezes are nothing new either.
Of course.
As long as there have been
yeah,
shorts, there have been short squeezes. Usually, it is fund to fund. So usually, one firm is short, and then you'll have another firm who says, "I don't like that," and they do the same thing that all of these retail traders do. It's just an issue now because it's multiple small people instead of
Right.
a firm to a firm or a few
But at the
firms
end of the day,
to a few firms.
a market is just a meeting of buyers and sellers. So this is just the way I don't know how movements go, Someone to buy
Exactly.
something to sell.
and I mean, with that being said, I think with the time constraints, I think it's time for us to move on to this final part of our discussion,
Yeah, man.
which I find interesting. I mean, you guys remember the last crisis? Well, not a pandemic, but just a crisis.
To an extent. To an extent.
Remember reading about it? I was young.
Exactly. Remember
I was
reading
young.
about it and now we're old enough to actually feel like we were there.
Understand and be actual players and participants and seeing it and understanding to that degree.
Yeah.
Yeah. I mean, and you can take some notes from that and combine it with what is happening right now, and which is why my views are a tad bit skewed when it comes on to the whole of the onus or the blame is on the retail traders side. I mean, these guys, as I said, they don't even realize that their own hedge fund brethren, as I would call it, even though they're competitors, they bet against each other all the time. And that is where the majority of the money is being circulated. You think about a regular retail investor. I mean, oh, the value to have a portfolio value of over $100,000 is probably rare, for a regular retail investor. So we go back to 2008 financial crisis now, and we think about it. We say 2008 financial crisis wasn't just a sudden event. It was something that was in the making. We can see that there were bad practices in the US because of various changes in Congress, various changes to amendments. And this was from President Bush's time when there was a slow deregulation of banking. And when deregulation happens in a financial industry, and as we spoke about before, these are capitalists. These are people that are going to go to the edge of the earth to make the most money for their firm. So you can probably find shoddy practices, financial practices happening, regardless even if these are the most esteemed institutions in the world. So these effects leading up to 2008 were felt from as early as 2002. From the early 2000s, we went through the dot-com boom, the dot-com bubble, all of that. But primarily, what we saw happening was that due to the deregulation of these banks and large hedge funds and firms, what we found was that there were a lot of loans and mortgages. Some of these brokerage houses and banks were selling AAA rated mortgages, which were actually subprime mortgages, to clients who were so risky that it almost did not make sense. There was a high spike. Go again.
To clean up that part a bit, what they were saying, or what they were selling was a completely new instrument that they created. So it was a new security backed by mortgages. And what they did was, so it was a few mortgages bundled together, and then they would call that a security and then sell you that security. What they would do is include some subprime mortgages in those securities, and over time, more subprime mortgages, rather than selling you the mortgage directly.
That was definitely part of it, but how it started was actually giving real mortgages to people, not derivatives or not, packaging it. It went on to more complex regimes like packaging it up in new unit trust format and also derivative trading format, after realizing that they were making big mistakes. So the loan environment was just okay. These customers can get a loan, even though their background checks did not signify that possibility. So after seeing this, the banks realized that no, just as Sean was saying, we now need to package these mortgages and these loans in different ways. And just as Sean said, they roll out that and say, okay, we're going to sell it as a package. Okay, you get this subprime mortgage unit, whatever, and you have this period to repay. But still, the system was already bad. So all of these mortgages now were creeping upon them with repayments. And these repayments weren't being serviced at all. And now there was a development in about 2006, which gave rise to derivative trading, where literally banks were selling their obligations and they were allowed to trade across banks. So bankers were now betting against this bank's clients that they would actually default. So you have a bank telling people that, okay, yeah, man, come here and get your mortgage, buy these derivative packages, buy these packages, and come on, get your mortgage, whatever, take these loans. And then you have another bank seeing this and looking into these credit reports and all that and saying, okay, these people are going to fail because they can't pay back. And literally, it became a ticking time bomb. And these banks, and this is where capitalism gets wicked, they actually were like, okay, there's nothing we can do to turn this back now. Let's just basically wait until it fails, because we are now so big that the US government is going to bail us out. So it starts with Lehman Brothers. Lehman Brothers goes belly up. And all of these companies now are saying, okay, who's going to buy out Lehman Brothers? Who's going to buy out what was the name of the other institution? You guys remember the name of the other banking institutions that went belly up in this pandemic? It's like there we go. A lot of these places were acquired by these major banks that you see now: Goldman Sachs, Bank of America. I
remember Lehman Brothers was broken up and sold in pieces.
Yes, definitely. And right there, the banks literally, they brokered a truce. They went to trial. Nobody got charged or anything for that. And hedge funds lost a lot of money because, as you know, hedge funds and all of these retirement funds are usually heavily invested in real estate, because real estate is seen as the strongest asset class. So billions of dollars were lost. And all of this was just through exploitation of clients. So it can be argued that this retail trader frenzy bankrupting some of these hedge funds can just be karma. And I mean, even if you look a few years after that, with the rise of the Chinese companies coming to the market, I mean, you guys would have seen a lot of them now, of what we call SPACs, special purpose acquisition companies, where, as you know, Chinese companies cannot direct list on the New York Stock Exchange. So you would usually acquire, let's say, redundant or shell companies on the US market through reverse mergers. So all of these companies were now coming to the market, and people were looking for avenues to invest in after the financial crisis, and different brokerage houses were now saying, okay, yes, let's go to China, invest in some Chinese companies. But one big wall of regulation in China is that Chinese investors cannot be prosecuted in their own country, nor can their records be automatically drawn from a public file. So if a Chinese company does shoddy behavior in a next jurisdiction, which is another country like USA, let's say defraud, put up fake statements, they cannot be charged. And this is why there's always some kind of upheaval when it comes down to investing in Chinese companies since after the financial crisis, because it's a bit of a gray area over China of how regulations and how SEC marks these companies. So with the rise of these Chinese companies, people were investing in them with the hope that okay, something is going to come better because the bank stocks were decimated in America after all of the findings of these malpractices and so on. So everybody was looking to China. And it so happened that these Chinese companies were even worse because they had balance sheets that were not in existence. They were claiming that they had all these equipments. They were claiming that they had the largest farms in Europe, in Asia, Europe, the entire world. And upon investigation, especially by short sellers, it was a short seller who found out one of these Chinese companies because it is his job. Because this company was moving from $1 up to $10 because there was so much rave in the US about these companies, and none of these brokerage firms were doing any research, in-depth research on these companies. They were just taking these filings from the auditors and saying, okay, this is how it is, this is how it goes. When in actuality, these companies literally did not have a red cent. On paper, these companies were saying they were valued over 100 million US dollars, when in truth, they were probably valued less than a million US. And there was one short seller in particular. He went to China, which in truth, you can be prosecuted for going to China and trying to spy on companies because China's laws are very different as to that of US. Their financial laws are not as stringent at all on their companies. And if you're caught spying, you will be imprisoned. But this guy's a short seller. So it is his duty to go and find bad companies. And this company in particular, when he went there, as they were claiming they had the most agricultural products, and so this company literally just had one truck doing a delivery. One truck. And when he came back with his surveillance images and all of that and put it on the market, and he was saying that he felt so bad because literally there were plenty of interviews done on completely bankrupt families who had their life savings put into some of these companies because hedge funds and banks were recommending them, literally saw their monies wiped out overnight. Because when this short seller guy came to the market, because remember, it's somebody's job to be a short seller, and it's somebody's job to go long. And when he came to the market and said, listen, this company has nothing, the stock literally went to zero, dissolved, delisted. And all of these shareholders, if you guys watch China Hustle on Netflix, you'll see the whole story. I mean, up to $14 billion of pension funds and retirement funds were completely blown. 14 billion US.
Crazy stuff been happening over. But so I think here is where Dustin, your mic is muted.
I was just saying that finance is event driven, man. You're always going to see these kind of situations come up. It's just a matter of value, whether it's overvalue, undervalue, or failure value. just this kind of exchange. Right.
So there are two takeaways. There are two movies that you guys are gonna want to watch, all the viewers. So there's China Hustle and that's on Netflix. And another thing that's good to watch is The Big Short. And I will give you an explanation as to what shorting is and what really how that shorting thing happened in relation to the '08 market crisis.
Oh, The Big
Yeah.
Short.
I'll
That guy made
put
a
it in the
lot of money
description.
off a short in the market.
I'll put it in the description. So the China Hustle and The Big Short are two most-watch movies, especially after this video.
And you can't leave out The Wolf of Wall Street, and you can't be talking about Wall Street bets without The Wolf of Wall Street, you know?
Oh, fuck stuff. That's in the same way how these Chinese companies that David was talking about, in the same way how that these companies would sell the shares to investors. It's the same way in Wolf of Wall Street, where they call them and sell them this whole story about how it's an amazing company when the company is out of one garage. It's the same way how these
Exactly.
guys.
Wolf of Wall Street was based off of the same concept.
Right.
Selling a man
Yeah,
selling
so-
something as garbage and packaging it up with roses and all of that, just so you can buy it. Which is the world for you. That's a capitalistic world for you. Somebody has to sell garbage.
I mean, they
It's
don't
just
have
up to us.
They choose to.
It's up to us
No,
to
I
become
mean,
financially literate.
the reason why I say somebody has to sell garbage, it's just a given. Just like how we have con artists out there and so on. Somebody's going to come at you with inferior product or garbage. It's just we as prudent investors have to do our due diligence and do our overextended research to say, okay, this seems viable and this is not.
Mhm.
Indeed. But all right, guys. We're running close to an hour now here, so I think we've covered pretty much everything. Anybody have any last points they want to add? We took a huge tangent, but anything?
Yeah. Also want to add is that if you don't want to keep up more or try to keep ahead of the curve and try to get an idea of what WallStreetBets is doing, you literally going to have to go on Reddit, keep in touch there. We'll definitely be keeping in touch with you guys in terms of more developments as I turn on more interesting stories. And we'll be bringing you all the market information that you need to know. All right.
Definitely.
If you want to talk about, just reach out to any one of us or the 876 investigators. Link should be in the description. The handles.
Indeed.
Right?
All right.
Thank you,
Final
everybody, for
points,
watching.
guys.
All right. Thank you, guys, and we'll see you soon.
All right.
Remember to like, subscribe, and share with all your friends. Yes.
Tell us
Definitely.
leave
Like
a comment.
and subscribe. Definitely.
Leave a
Turn
comment
notification
on what you
bell.
guys want us to review next to this.
Turn on the notification bell. Wow.
There we go. All right.
All right.